Great. Good day, everybody. Let's get started. Welcome to the Fortia Group's Q2 2024 report on the state of e-commerce brand valuations. Today's agenda, firstly, I'll kick off with a brief update from the Fortia Group. We'll then, as we've done in prior sessions, walk through the Q2 report that we're publishing today. We have some great guest speakers, which we'll introduce in a moment, and we will allow time for your Q&A. From a Q&A housekeeping perspective, please submit any questions you have during the webinar via the Q&A button. Please kindly do not submit them via the chat button. They won't be answered. It's much easier for us to facilitate and share questions via the Q&A button. And this recording, like all previous recordings, are available via our channel on the YouTube. So please just put in the Fortia Group into YouTube and you will see all prior recordings. The deck will be sent to you as part of the follow-up in the coming days. So let's start from the Fortia Group perspective. For those that are new to us, just to emphasize what we're all about, our mission is to be the leading e-commerce bank for the lower and middle market. That means doing deals anywhere from high single digit up to 100, 200 million revenue type brands. That's the sweet spot that we're targeting. We feel there's a great opportunity there, particularly given the background of the three co-founders of the Fortia Group. I'm ex-Morgan Stanley. I've worked on over $20 billion of deals since the year 2000. So I bring sort of bulge bracket Wall Street level of advice and experience. I'm complemented by two founders who bring different types of experience. David brings rigorous financial and CFO type experience, having worked in e-commerce himself. And Paul brings operational e-commerce experience. A lot of investment banks just have finance geeks like myself and David, but Paul brings deep operational experience. And that's critical when we really have to dig deep and understand a company and position it for an exit and articulate its growth story in a meaningful and believable way, which is clearly key to getting the best valuation. So we're delighted to work with our clients. All of us are involved in all of the deals that we do and bring complementary skill sets. We recently started doing what we call valuation audits. So a lot of brands come to us and they're not ready to sell today. They want to say, they come to me and they say, we want to exit in 2025 or 2026. And the way we help those firms is by doing a valuation audit of their business today. That's a deep dive, look under the hood at the financials and the data in order to give advice to the entrepreneurs on what they can do to increase their valuation over time. And the biggest thing that annoys me with e-commerce entrepreneurs is they don't prepare properly for their exits. An S&P 500 company starts preparing 1 to 2 years out. Lots of e-commerce folks start 1 to 2 months out, which is frankly not the way to do it. Please reach out if you'd like thoughtful advice to help you set you off on your right path over like 6, 12, 24 months so that when you do ultimately press the green light on a formal competitive exit process, you're in the best position possible. Okay, so let's walk through the actual report. As a reminder, in our view, there are 6 factors that drive valuation, some outside the control of the entrepreneur, some inside and under the control of the entrepreneur or brand. Firstly, global M&A activity. What's happening in the global markets absolutely affects the valuations of any unlisted private e-commerce brand. And so that's where we'll start today. We'll look at where we are in terms of global M&A activity. E-commerce trends is obviously critical to understand what's happening from a sectoral perspective. And we're delighted to welcome Grips back to this webinar today. They have, in our view, the best consumer transaction-based data set available to give insights as to what's happening in real time in the e-commerce sector. One can't think about valuing private unlisted companies without looking to the public listed markets. And we're delighted to have Austin from DrivePoint to give us his view as to what's happening in public markets. And there's been some interesting posts from LinkedIn from people we follow that will bring to light and will shed light on that area as well. E-commerce M&A activity is clearly key. What's happening in our world? Delighted to welcome Simon, who'll introduce himself in a moment. He is a partner at a new firm that's doing acquisitions. Great to see a new acquirer of e-commerce brands come to the market. Then we look at items that are under one's control, brand metrics. We'll give some examples of that and how our brand valuation audit can sort of help you shine light into where you are today and where you might want to get to. And then deal dynamics, often overlooked, but there's lots of factors that can be that can affect the ultimate price that one might obtain, and we'll give you 2 examples of that today. So all those 6 factors lead to valuation, and as we do in all our webinars, we'll give you our thoughts on where valuations are today for both DTC-led brands and FBA-led brands, and where they might go in the near term. So before we jump in, could I ask, please, our guest speakers to introduce themselves, starting with John?
Yeah. Hi, thanks for having me today, Emmett. My name is John Fetto. I am the head of e-commerce insights for Grips Intelligence. We track thousands of e-commerce sites across the internet and their online performance, and I'll be talking about some of those trends today.
Thank you, John. Austin?
Hi, everyone. My name is Austin Gardner-Smith. I'm the co-founder and CEO of a company called DrivePoint. We are a strategic finance platform for omni-channel brands. So we work with consumer brands anywhere from $5 to $300 million to help with financial modeling, forecasting, planning, scenario analysis, and ultimately helping them make better capital allocation decisions so that they can increase their valuation and be in a great position to work with Emmett and team or others to succeed and achieve a successful exit. So brands you might know, Oats Overnight, Curology, Simple Modern, Dose Daily, a bunch of other companies sort of in that space selling across e-com and omnichannel are our bread and butter.
Thanks, Austin. Simon?
Hi, I'm Simon. Thanks, Emmett, for the invitation to join the webinar today. And a quick shout out to John Fetto at Grips. We're a big user of Grips data and intelligence. It's really integral to what we do, so thanks a lot. I started out with an analytics business called Conjura, which basically provides analytics services to brands. And that business provides services to lots of brands, but in addition, it spun out a lender using the same data engine. We spun out a lender called Wayflyer. That will lend to lots of brands in 2024, probably around 3,000 brands. And then from that, we also spun out a private equity business, which is now called Apex. Previously it had a different title, but we acquired a few brands over the course of the last few years, and we're big on internationalization of brands. But we do pretty rigorous commercial due diligence with our data engine and benchmarking with the help of Grips.
Great. Thank you all for taking time out to speak on today's webinar. Okay, so let's jump in. So the first of the 6 items that can affect valuations is global M&A activity. For those that attended our last webinar, I showed you this chart, and I just want to go back to this because it's sort of key for thinking about long-term trends, and then we'll bring you up to date with how 2024 is starting. But I think personally, as someone who's running a boutique investment bank, this is really encouraging, right? Obviously, M&A volumes were down significantly in the recent past, but they've never decreased for 3 years in the last 30 years. So that's encouraging, right? And this is data from Goldman Sachs, come back to 89. So with declining interest rates, yes, they've been slightly delayed to when we want them to decline, and an improving economy, we should see increased volume this year. So I think that's good for all of us on the call. There'll be more deal flow. To sort of see that play out, this data is from Dealogic. We are seeing deal flow pick up in Q1 2024. So these bars are the first quarter of each year, to show on a like-for-like basis. So Q1 2024 is up significantly on Q1 2023. Clearly down from the heights of 2021, 2022, but that's a positive step forward, and we'll keep you updated as we go throughout 2024 to sort of evidence if we continue to track in the right direction. All eyes are on interest rates. Clearly that's the key lever for all of us in terms of the cost of credit, the confidence of boards to do M&A, etc. And the best sort of the most accessible piece of research that we could find in the last weeks on this is from Morningstar. So they think that the rate will fall to 2.5 to 2.75% by the end of 2025, and getting to 4.25 by the end of 2024. Again, they think it's going to be at the June 2024 meeting. Touch wood, it is. That's clearly slightly delayed from what we expected. But the broad trends are going in the right direction. It's a question of when, not if. So all eyes are on that. As soon as that happens, or as hopefully by the time we do our Q3 update meeting in early July, we have declining interest rates, and we'll be able to show you data that shows that you know, there's increasing positivity amongst acquirers, boards, etc. to do deals. Okay, from an e-commerce trends perspective, as discussed, we hand over to John from Grips. Over to you, John.
Okay, thanks, Emmett. Yeah, so I wanted to show like the first slide here, just talking about general e-commerce trends. Now, Grips is, we published our quarterly e-commerce forecasts or estimates right around this time. We're about 1 week out from our official growth publishing for Q1, but I wanted to share kind of the historical data that we have and the initial reads that we have for Q1. As you can see, the numbers that Grips publishes every quarter correlate very, very strongly with the census estimates. In Q4, we projected that the e-commerce category in the United States grew by about 10%. The Census Bureau reported that it was about 8%. Right now, we're looking at January and February estimates, putting our estimates conservatively, we think, for the United States as a whole at about 5%. But we did look at some of the March data also, and it's a little bit better than January and February. So that 5%, I think, is a conservative estimate for the quarter. So we think we should be somewhere north of 5% for the e-commerce category overall in Q1. If you want to see our official estimates, which will come out next week, you know, I've got my email address up on the screen. Feel free to email me. I'll follow up with you. I did want to also comment about some of the other early indicators that we're seeing for the category in Q1. One of the things that we've noticed is that conversion rates are continuing to decline a little bit in the quarter, as well as average order value. That is coming at, you'll see it on a future slide, as a result of rising prices. Consumers are probably pulling back as prices are still continuing to stay a little bit higher than average. The fact that the industry is continuing to grow, though, however, means that sessions and traffic are up year over year. So focusing on growing traffic will be a major defense against some of those headwinds that are impacting the category of declining conversion rates and average order value. It also means that driving additional traffic through paid channels may become more expensive, as more of your competitors are also fighting to grow their traffic to combat those declining average order values and conversion rates. If you want to go to the next slide, Emmett, we'll kind of look at that, at the growth that we're seeing by category. So we can see that we have the major e-commerce categories showing here on the slide here that are tracked by Grips. Again, this is tracked against 50,000 different e-commerce sites across the web, and we're able to break that down by category of goods and services that are being sold. You can see here on the top half of the screen are those categories where the prices are growing the most. And on the right hand, we'll see the categories that are growing the most. As you can see, most of the categories are showing positive growth year over year. In fact, there's only 2 categories that have shown declining revenue in Q1. I'd rather January and February. We don't have the final numbers for Q1 ready just yet, but that should be a good indicator. The one, that we are looking at here is electronics. Electronics is still kind of the biggest category to still be in negative territory for revenue. That said, digging into electronics, what's really drawing it down is computer sales. In Q4, we did see kind of a rebound in computer sales, probably driven by kind of the holiday sales that got a few people back into the buying mode for computers specifically, but they have declined again in Q1. So we're having a rough reboot to the computer category. But the rest of the electronics category doesn't look so bad. The other category that's showing declining revenue is health. And I should say that a lot of that is driven by the problems that CVS and Walgreens are having. That doesn't mean that everybody's down across the board, but it does create a drag on the category. In fact, it creates some opportunity for grocery retailers. Kroger, Safeway, and similar sites are showing growth in their health category as consumers maybe move away from some of those traditional pharmacy websites. But now I'll focus on some of the growing categories, and I will dig into a few of these here as on a dedicated slide in the next couple of minutes. Food and beverages is the first one that I want to mention. We've talked about this generally. There we go, back to that slide. Food and beverage is the one that we've been talking about regularly. It's been growing regularly over the past few quarters that we've been looking at this, and we'll dig into it a little bit. But the thing to call out here is that it's one of the few categories where we're seeing prices coming down, obviously much to consumer satisfaction there. Another category that we want to dig into next that's growing is the hardware category. We haven't talked about it in a while. I think it's a relevant one to dig into. We'll talk about it in a few minutes. And we also have categories that are eternally growing. Pet supplies and vehicle parts are still growing. People are investing in kind of keeping their vehicles a little bit longer, cleaning them, maintaining their vehicles. That's what's driving that growth. And then home and garden, and we'll dig into that in the next couple of slides. So Emmett, you can go to the next slide. The first category that I want to dig into is hardware. So again, we haven't talked about it in a while. One of the main drivers in this category you can see is power and electrical. In fact, one of the trends that we're seeing across multiple categories, but it's, I think, illustrated very well here in the hardware category, is investment in kind of self-sustainability, self-reliance. People are buying backup generators, fuel cells, which is reflected in the electronics category. So people are really kind of investing in making sure that they and their families are sustainable, maybe able to live off grid. Another category that's growing pretty strongly in Q1 or in the first part of Q1 is the HVAC category. I think we're still seeing the impact of state and federal subsidies and tax breaks for upgrading to more ecologically friendly heaters, air conditionings, and things like that. And that's driving growth in that category. The fuel containers category, same thing, along with that kind of self-reliance. People are backing up, having some fuel to power those generators on standby. But not to be, forgotten, we are still seeing a pretty decent amount of growth in just kind of DIY home renovations and repairs. You see the building materials, plumbing, consumables, those are all growing by more than 10% year over year in Q1. And obviously the big one there is tools. I've called out a few individual brands that we're seeing some decent growth in on the side. 3 of them are kind of in the generator category: Predator, Duramax, and 4Patriots. In fact, if you 4patriots.com is a whole website dedicated to kind of like that self-reliance trend that we're seeing, and it's growing very quickly. Anchor, fuel cells, battery backup generators, and then 3M is building, providing a lot of those like building consumable categories, and that's growing at about 18-19% year over year. So it's an interesting category to watch. Even if interest rates are high, there are people investing in home renovations. Although, as I want to mention, like the building materials and plumbing, the prices are still quite a bit higher than they were even a year ago. So we're going to watch out for that. The next category that we'll look at is like the home and garden category. Similarly to that self-sustainability, we see the fastest growing category here being like outdoor power equipment. We're seeing like saws and chainsaws and things like that going up. But this winter, we also saw a pretty decent rise in sales of snow blowers. Going along with that, kind of generator backup. Maybe people were preparing a little bit more for the possibility of being without power and being stuck by winter storms. Last quarter when we talked, we also mentioned kind of the growth in the home and garden category in like the entertaining sector. Saw a lot of outdoor living, outdoor structures that people were investing in and growing ice makers, wine fridges. We're still seeing that in Q1. But we're also seeing kind of a focus on smaller appliances. Again, we see the ice makers in there. We see mixers and blenders. We see food cookers and steamers. So again, counter-based, small appliances are doing particularly well, whereas like refrigerators are showing declining revenue year over year, and ranges are more or less stable. If we look at some of the growing brands, a lot of them are kind of the small appliances. Vacuum cleaner Bissell is doing really well year over year. Presto, they make countertop steamers and cookers. Mr. Heater, again, a like space heater product generated tied to some of these other categories that we see are growing pretty well. And then Hexclad, it's if you've been on social media, you've definitely seen a lot of ads for Hexclad, and it's one of the growing categories in cookware and bakeware. And then we will kind of wrap up with a look at the food and beverage category. Again, the thing that I want to point out here, this is a category that's been growing really strongly every time we've looked at it. The one thing that's somewhat different in Q1 is that it's not the beverage category that is driving the whole category sale. In fact, liquor and spirits has been growing, leading far and ahead the growth in this overall category for quite a while. But in January and February, it's down to just like 3-4% growth. One of the trends that I think is tied to that is the growing popularity in dry January. We've seen that growing year over year. And liquor and spirits definitely seem to cool off its growth in Q1. It's still growing, but not quite to the degree that we've been seeing in the past. Other big categories that are still continuing to grow, you see that whole cluster in the middle where their prices are up and revenues are up. Soda, condiments, meat, eggs, fruit and vegetable, coffee, all doing quite well. I do want to also look at some of the products that are kind of showing declining prices, but still showing profitability. Non-dairy milk, I always think this is an interesting one. It's now a bigger category online than dairy milk, for obvious reasons. It's shelf stable. Beer, the beer wars have definitely brought the prices down, but spending overall is up. Prepared foods are up, so people are still looking at at making items at home with their dry ingredients, but also still investing in prepared foods. Some of the growing brands to wrap up here, Celsius, these are kind of the new reinvented like energy beverages with more health features that are prominently called out. Lindt growing, that's probably drawn from leftover Valentine's and the lead into Easter. But then two other brands like Thrive Market and Rancho Gordo, these are sites that specialize in kind of shelf-stable foods, dried beans, and other ingredients that can last in your pantry for a long time. These are growing at a much faster rate than typical products in the food and beverage category. So ones to keep an eye on for the year ahead. Again, I'll answer any questions in the Q&A or on the chat, but thanks, Emmett.
Yeah, thank you, John, as ever. Super insights, effectively real time as well. Great granularity. Yeah, just as a reminder, if anyone has any questions, please submit them via the Q&A. John will answer questions as we go by typing the answers or verbally at the end of the webinar. Great. So let's move on to public market comparables. Austin, over to you, please.
Yeah, awesome. So thanks everyone, and super insightful, John. Always fun to see what's going on below the waterline there on a lot of these brands. So our data source or sort of what we're using to derive some information that's hopefully useful from the public markets is what we call the DrivePoint D2C Index. This is a basket of public market securities that we've been tracking since late 2020 that we believe represents sort of the best of a primarily direct-to-consumer online model. A number of these brands also have retail and have wholesale distribution, but we sort of filtered for those that we think are, quote unquote, direct-to-consumer first. So you can see some of the logos down below in terms of who makes up this index. So if you flip to the next slide, at a high level, these are sort of the median values and the things that we track, obviously trying to track understanding of revenue and sort of what scale these brands are operating at, growth in terms of the revenue change over the last year, a rough guess at our percentage of D2C revenue that comes from filings and our sort of general knowledge of these brands, as well as a number of margin metrics. And then obviously, importantly, both an EV to sales metric and an EV to EBITDA metric. And so looking at these, I typically look at the median line, second from the bottom, as kind of being the best indicator or benchmark for us. EV to sales here has been hovering right around a 1x, I think, for the better part of the last almost 2 years now. In 2018 and 2019, we saw that EV to sales multiple up over 3 or 4 at certain points. And I think, what's happened is that the market is relatively rationalized on this front. And the reality is that there aren't that many deals getting done either in the public markets or the private markets based on a sales multiple. And Emmett, I'm sure you'll have some data to back that up as well. So the most important number that we sort of look at or tell our brands and our prospects to focus on is that median EV to EBITDA multiple One, to get them in the idea that your business will trade on an EBITDA multiple most likely, and not on a sales multiple. No matter what anybody says, I think the cases where you're able to trade on a sales multiple are, while they still exist, are very few and far between at this point. And so we see that median number around 7.1. That's the latest reading. We've seen it basically with a 7 handle for the better part of 2024. On the high end, we do see brands. There are some extreme outliers here, up around 70. Those are sort of small market brands. I think that the anchors for me basically are, if you look toward the average or some of those higher numbers, are brands in the portfolio, hovering around the mid to high teens. So I mean, if you flip to the next one, I think we've got the longitudinal chart, which can kind of show some of the data. So, one thing that's interesting is a little bit of drift here between the EBITDA and the sales multiples. I think this is sort of mostly made up of individual names moving back and forth. And then you do see sort of that uptick from that low right at the end of 2023, where we were coming down on EBITDA multiples. We've come back up a little bit. We did have a pop on our last reading, just over 8, but now trending back toward about 7. So that seems rational. If you flip to the next one, these are the individual names, and so you can kind of see how they're trading. If you stack rank these by EV to EBITDA, you end up with a couple of interesting brands. Oddity, Lululemon, Figs, and Yeti top the list if you sort descending for multiple. And I think what's most interesting, all of these brands are commanding an EBITDA margin premium compared to the other brands. So in that group, almost everybody at or above 20% EBITDA margins. Oddity hovering just below. Lulu, last post over the last 12 months, about 27% EBITDA margins. The only outlier on that list is Figs, which is an apparel brand, which seems to be both on an EBITDA multiple and on a growth multiple, trailing a little bit below. People love that brand, and investors seem to love that brand, partially because of the vertical focus. That's a really interesting one to focus on if you're an entrepreneur in apparel or soft goods, sort of having a very niche market audience. And then others in that space, Yeti in the high teens consistently, Canada Goose a little bit lower, but very high AOV. And then Crocs, I think, is a super interesting one to look at as well in the in the apparel space, at almost 27% EBITDA. So, beauty brands are commanding good multiples and higher margins. But overall, I think the trend has been, again, represented by EBITDA multiples somewhere in the 7 to sort of 7 as a median number, and maybe the mid to high teens if you're an exceptional player. I think that the adjustment that I always make in my head from public market comps to private market comps is that these companies are also being rewarded for scale. So most of these companies are, several $100 million or more of market cap. All of the leaders are, almost are over $1 billion of market cap, save for Figs. And so you're probably going to have to give yourself a little bit of a haircut as a private company from these median numbers, just in terms of scale and the amount of risk that a potential acquirer or buyer has taken. So that's kind of the headline. I mean, if you flip to the next one, one thing that we had sort of discussed and then Emmett asked me to look at a little bit was the power of subscription, or sort of trying to filter for subscription as a dynamic in some of these businesses. There aren't great examples, or at least not a myriad of great examples of subscription models in the public markets. It's very difficult to kind of discern which are which. And some of the subscription box models that are out there, I don't think are particularly good comps for your average e-commerce brand. So I actually looked at our company data set. So this is private company data from DrivePoint across our customer base. What I did was pull a sample of companies that I consider to be essentially subscription first, and compare those to a sample of companies that I compared, to be sort of one-time purchase first, or OTP. So you are going to see more of supplements and others. So I think what's super interesting here, I looked at revenue growth here on the left. So the average revenue growth for a subscription first brand in 2023 was over 100%. The average growth for an OTP first brand was 47%. And so I think what's particularly interesting there, a lot of those OTP brands are heavily reliant on customer acquisition. They're just more sensitive to the customer acquisition markets. And as we've seen rising costs in the digital market, particularly in Meta, it's been harder for those companies to scale, and they have pulled back a little bit on spend and started to take a slower growth trajectory to preserve profitability and to make sure the business stays strong. Those subscription models have been able to trim some of that spend as well. They've been looking at a lot of the same things on the acquisition side, But because they have a base of existing customers who are going to come back and repurchase, the revenue growth numbers haven't slowed down quite as much. Same thing on the right-hand side. If we look at contribution margin for the subscription first brands, we see an average of almost 56% for 2023. Contribution margin for the OTB first brands down around 40%. So in both cases, not horrible numbers in terms of growth compared to the public market comps, but I think there's a pretty stark difference between subscription and non-subscription. And obviously that will drive, that contribution margin flows down to EBITDA margin. And so you're going to get a valuation premium for some of that subscription business. If you flip to the next one, a great example of this in the public markets, or kind of seeing this play out, is Hims. So Hims, if you guys aren't familiar with the brand, essentially provides healthcare services hair care and ED and some other benefits. So I think probably the most extreme example in that you often have a medical need that's kind of close to a prescription. So this is an example of kind of the far end of the spectrum in terms of excellence on subscription. But what's been super interesting to watch is they've disclosed a lot of their internal data around subscription, revenue mix, those sorts of things. Is that as they scale, they're starting to see that sort of vision of subscription come to life. And I think that's why investors are rewarding them. So basically their recurring customer revenue now makes up, even at scale, well over 50% of their revenue. And that's allowed them to improve their margin profile, even while spending a ton of money on customer acquisition. So these guys are spending almost 50% of revenues on customer acquisition, and yet their margin profile continues to improve because they're able to have that strong subscription base over time. And so I think as an e-commerce operator, this is what an acquirer is kind of looking for, or underwriting, in my opinion, when they're saying, hey, I would love it to, I have a bias for brands that have incredibly high repeat rates or incredibly high subscription. Because at the end of the day, at scale, the idea is that you will be able to continue to drive up that margin profile over time, because that recurring customer base is delivering so much contribution to the business. So anyways, just pointing that out, there's a great deck on the Hims investor relations slide that I would encourage all of you guys to look at, that has some great internal data, but kind of fulfilling the prophecy of subscription and why valuation premiums may be higher for subscription companies.
Thank you, Austin. Super insights as ever, and thank you for double clicking on the subscription model. It's something we get asked a lot, and how it affects valuation, which we'll touch on again later on in the webinar. Excellent. There was one slide here.
This was the last, just the last point there. That's allowed Hims to trade above that median multiple, right? So showing that the impact on the actual valuation.
Yeah, interesting. Significant premium, yeah. Excellent. Okay, I just wanted to just finish off this section by just posting two recent posts 2 days ago, 1 day ago, from two people I follow on LinkedIn. Fan B is CEO of a DTC acquirer called the Hedgehog Company that the Fortia Group has a small shareholding in. He says the biggest lie in e-commerce is the strategics will buy a business for a revenue multiple. This is the extreme exception, not the rule. I think a lot of entrepreneurs hope to get a revenue multiple. Our own view at the Fortia Group is that if it's a 100% subscription business or largely subscription business, then you have the right to seek a multiple on revenue. Ultimately, it'll probably be quoted as a multiple on EBITDA. But if a subscription high growth, you have the opportunity to be called a diamond, which we'll talk about later on this webinar, which can be valued in the teens as opposed to a single digit EBITDA. And if you translate that back to revenue, it can be a small multiple of revenue, probably starting with a 1, not necessarily a 2 or a 3. But a fan is worth following on LinkedIn. For those that aren't following him, always posts a very interesting, thought-provoking comments. And Nicholas Ling is also a founder of a company that acquires DTC brands, and sort of building on some of the performances of listed stocks that Austin was talking about. It's worth reading this post in a bit of detail if you get a chance following the call, or when you receive this deck from us in the coming days. He has sort of 3 ways for brands to sort of to do well going forward. One is to have gross margin rules that should be at least 50%. For context, P&G is at 54%. the right growth targets in terms of overall growth. He's saying it needs to be at least, sort of 10%. Warby's at 12%. Honest is at 10%. And the brands have to get leaner. This builds on what Fan is saying. Basically, you've got to get to profitability, or you won't be able to survive or get a decent multiple. Nick points to 3 ways to do that, which are leveraging technology, artificial intelligence, and offshoring. So something there to think about going forward. Okay, in terms of e-commerce M&A activity, obviously we've seen the global M&A activity, which is starting to rebound. We have done some deals ourselves in the last few months, and things are getting better. But what we wanted to do is show or introduce you to Simon, who's partner at a firm, a new firm that's starting to acquire brands, and inject a bit of positivity into the space that's had a tough 2 years. So Simon, over to you. Are you there, Simon? We can't hear you yet.
Sorry, apologies. Thanks, Emmett, for that. And also thank you, Austin, for your presentation as well. It does resonate very closely with private markets as well. So I don't have any slides today, but I just want to take you through our experiences in the last quarter. One with where we're trying to sell something, one where we're trying to buy something. I think just to mention one thing, we definitely don't have the scale that Austin alluded to in the last presentation, and scale does most definitely matter, because ultimately the discount that you are getting for lack of scale is pronounced. So on the one case, we've got an asset that's been growing using Grips intelligence in the top decile in beauty or close to beauty. We've had 77 conversations with the private equity buyer base, and we've also had a bunch of strategic conversations. So this brand has grown triple digit and has done it for 3 years. It's a global brand, and it's also multi-category. But ultimately, even with those heroic metrics, a third of the private equity buyers, who are all direct consumer focused, are not looking to invest in anything currently. Or 2/3, sorry, and 1/3 did have interest and are looking at it closely. But ultimately, for that brand, it would have been doing sold at least a 20x multiple and 3 times revenue multiple only 2 years ago. On the flip side, an asset that we're looking very closely at, which is in direct consumer, also not quite e-commerce, but very close to e-commerce. It's got a 75% EBITDA margin, not quite e-commerce, as I said, but 75% EBITDA margin. And that business we are looking close to acquire shortly for a 5x multiple, and that's gone to 120 investors. Now, I think once again there is a bias to being either further west of Europe, and the further west you go of Eastern Europe, the markets become more attractive for equity capital markets, that is. So all I can say is that until we see the elections out of the way, and until we see interest rates begin to come back down again, I think we'll still be a little bit disappointed with the opportunities that are available in the M&A market when you're a seller, and potentially very exciting if you're an acquirer, because of the gaps that are most definitely exist in the market currently. So what we're looking to do is to put capital to work, certainly with a very attractive entry multiples, with a view that some of these multiples will come back later in 2024 and early 2025.
Great. Thank you, Simon.
Thanks,
Okay.
Emmett.
So let's go to brand metrics. So we wanted to build on something I mentioned earlier on, which is our new valuation audit offering that we provide to brands and entrepreneurs. One of the things we do is within that is what we call a quantitative scorecard, where we rate your brand across a variety of metrics. So for this, we rate brands across various KPIs, such as revenue, margin, product, brand equity, the category, and give a total score. And we do this across lots of different metrics. So brand metrics are obviously in your control as the entrepreneur. But what we do is give you the view of what acquirers think of where you are today, and frankly, where you should be from a benchmarking perspective. We've talked about Conjura and Grips being really helpful data from a benchmarking perspective. There's, the best laid plans only survive contact with the enemy. You need to look up, take a step back, and think about where your brand is performing alongside others in the e-commerce space, your sector, your category. And be working towards the right metrics that acquirers will pay for. You may recall on the last webinar, we posted a slide by UBS, which showed whether the markets are rewarding revenue growth or bottom line profitability. Clearly, 2 years ago, it was all revenue growth. A few months ago, it was all bottom line profitability. 3 months ago, it was largely bottom line profitability with a taste of revenue growth. So it's important to know, it's important to sort of skate where the puck's going to be. If you're trying to sell in 2 years, touch wood, the world's a better place, and most likely we'll be back to sort of looking for brands that are about revenue growth. Today, it's clearly all about the bottom line because we're in a difficult environment. But in 2 years' time, I think that might be slightly different. So it's important to keep one eye on what's happening on the markets. It's always fluid, and linking that back to where your brand scores today and ultimately when you want to exit. As mentioned, we just have sort of to show you the granularity as to how we score on something like gross margin and other metrics. We go into a lot of detail to rank where each brand is across each of these type of metrics. If you'd like to see a free sample of our valuation audit, please reach out to inquiries at eaglealpha at thefortiagroup.com. Excuse me. So brand metrics. We've mentioned this in our prior webinars. We have a 90-page guide for DTC-led brands and another similar guide for FBA-led brands. They're complementary. You can download those from our website. They were co-authored but with 20 acquirers, each of those reports. So there's a lot of great advice in that to help one think about gearing up towards an exit. Okay, before we jump into valuation and Q&A, I want to talk about deal dynamics. So you've seen this slide from us before. There are lots of different deal dynamics that can impact valuation that people forget about. Or some forget about. That can be the situation of the shareholder. Is he or she, desperate or in distress to sell? What's the acquirer situation? Are they trying to complete a fundraising themselves and therefore more willing to get a deal done? Have you retained advisors? How you've gone about marketing, distribution, revenue, cost synergies with the acquirer, particularly if it's a strategic and deal structure. Today, I just want to jump in on two of these. I'm going to start with retaining advisors. So people often ask, a lot of entrepreneurs go themselves. It's strange, but most S&P 500 companies would never go themselves. They always hire advisors, but some entrepreneurs think that they can advise themselves despite having not done M&A transactions in the past. So to help shed some light on whether M&A advisors do add value, we've put forward this independent research which analyzed over 3,000 deals over a long 17-year period, and they came up with the stat which showed that good advisors can increase valuation of up to 25%, which more than pays for our fees. So I don't know how to operate an e-commerce business. I do know how to do an M&A deal, and would love to help advise you all on your M&A deals. So please reach out again to inquiries at the Fortia Group if you'd like to have a conversation. The other is marketing distribution. It's really key how you bring your deal to market. Some people just start emailing, 10 potential acquirers or 20 potential acquirers. That's not very efficient. One needs to take a step back and think, what are you bringing to market? Which acquirer does it resonate with? Whether they're strategics, private equity firms, or aggregators, or maybe even family offices. It's our business to know all the buyers of e-commerce brands. And one of the ways we do that is by hosting the only annual conference for e-commerce acquirers. And we had a great event in New York just last January, and our next conference will be in January 2025. It's a great opportunity for a select number of brands to pitch to the audience. And there'll be 175 acquirers in the room next January. Think of that as a Shark Tank on steroids, if you will. We already have some big brands committed, and if you'd like to explore that, please reach out. Another way to prove that we're very close to the acquirers is we have a WhatsApp group now of C-suites of acquirers. There's 132 members. We've had that for about a year. So that enables us to sort of promote interesting deals, but also help our buyer clients become better businesses themselves, and sort of foster a network amongst the community. We're the only business in the world that sort of is leading the charge on driving that community side of things. So we're very close to acquirers, which is key for any entrepreneur. You need to hire an investment bank that really knows the buyers. Okay, all roads lead to valuation. So just to recap, there are 6 factors that we've gone through today that drive valuation: from global M&A activity, e-commerce trends, public multiples, e-commerce M&A activity, brand metrics, and deal dynamics. So if you cut to the short of it, what Austin talked about earlier on was that the median for public listed comps was about 7.7x EBITDA. Well, and some people talk that there's a haircut to that needed for small businesses. Yes, that's true. There can be exceptions if the growth is really strong and there's good, protection, IP, patents, etc. But that's a great barometer. So let's just keep that in mind when we come to our range in a moment. So our range we present in 2 ways. We talk about FBA-led brands and DTC-led brands. 2021 was the height for e-commerce brands. We don't expect to be back there again. That was a one-off. Things have settled. M&A volumes were very low in 2022, 2023. They'll increase marginally in the first half of this year, and hopefully a bit quicker in the second half of 2024 as interest rates come down. We think that'll help get deals done, but we don't necessarily think it'll increase valuations. We may see an increase in valuations towards the end of 2024 or early 2025, a few months after inflation as interest rates have come down, and there's more competitive auction processes happening. But if we do see an increase, we don't expect a massive step up. It will be slight, if anything. And look, our view is to give frank, no BS type advice. We're not promising you that everything's rosy or that valuations will increase markedly. We're trying to tell you exactly what we're hearing based on all our feedback from our sellers, buyers, and experts we know in the market, such as John and Austin. So where does that leave us? We haven't changed our guidance. We still think FBA-led brands can be, and these are profitable brands. As you know, we don't work with distressed brands. So for profitable FBA-led brands, it's 2x to 6x. That includes deferred components, right? So you don't expect 6x upfront. It might be 3.5 or 4 upfront with a big chunk deferred. For DTC-led brands, it can be anything. It's a very wide range. I appreciate that's slightly unhelpful, but we're seeing such a huge mix. Some folks have declining revenue. Some folks just can't get CACs in order. So it's quite range between 3x and 12x. The median of that is broadly similar to the median that Austin referred to, 7.1x. And there's exceptions to the downside and the upside. To get to the upside, just to finish on a positive, we often get asked, what are diamonds valued at? And we'd like to show the slide to finish on a positive note, because it's been tough in e-commerce for the last 1 to 2 years. So look, if brands are hitting all the right notes, such as in a in-demand category, and it's really interesting to see John's data to show where is the growth in terms of revenue and pricing. So beauty is clearly still a favorable category. If the brand is bigger, the bigger the brand, the more reward, the more evidence that it's a real brand with a capital B, as opposed to still a very small startup. High revenue growth. It's got to be revenue growth, despite the tough environment. Large percentage of recurring revenue. So if it's 100% recurring revenue, as we've mentioned, there's an opportunity to get well into the teens and be at least a multiple of 1x of revenue. Particularly again, if you're in a favorite category like a pets or baby or beauty. We've talked about net margins, and that hasn't changed. And obviously, acquirers are genuinely looking for brands with a capital B that have a long-term omni-channel growth opportunity, ideally with some, patent and protection. That's what you would like to buy if you were acquiring. That's what acquirers are looking for. So hope that was helpful. I think we now jump to Q&A. Please submit any questions you have. We've got 8 minutes left. Let's see. The first question is Dominic saying he has to exit now for the airport? Well, thank you, Dominic, for listening in. Maybe while we're waiting for Q&A, the 7.1, Simon, what's your thought on that as the median? Again, I appreciate it's for listed comps, but where do you think the median is for unlisted comps, if I was to put you on the spotlight?
Sorry, Emmett. I think the market is, once again, there's a lot of gaps between where sellers have realistic expectations of what their businesses are worth. But having said that, once again, back to the right category with the right margin profile, I think growth will save your bacon. And if you have strong growth and you have decent margins, you will achieve, and you will find that buyer, but it won't be a simple and straightforward process. And I think 7 is very realistic median, but you'd be aspiring to something higher. But once again, I would most definitely say you probably want to get some superb advice during that process.
There's a question come in from Josh. In the rapidly evolving landscape of consumer electronics and homeware, with the rise of platforms like Taobao and Temu, potentially challenging traditional distribution models and impacting margins, how do buyers perceive the importance of brand identity and loyalty when evaluating investments or partnerships in this space? Any thoughts on that, gentlemen?
Sorry, go ahead, Simon. I'm happy to chime in after.
The only thing I would add is, sorry, and it hasn't been mentioned yet today, is the importance of when you talk about electronics, and I think that's what the question was on that category. It's where the IP sits, and that for me is really important. I think also the importance of a very strong NPD list. Like all investors are especially in that category, are very keen to understand what the risk is around new entrants coming in to take advantage of your sector.
Austin?
Yeah, I was going to make a slightly different point, which is I think electronics is certainly a category where we've seen a lot of challenge to maintain customer acquisition costs as you try to achieve scale, because it is so commoditized and often people are looking for an undifferentiated widget, especially on the smaller end of the market, as opposed to larger ticket items. So I think it can be very challenging there. It's interesting on the distribution models. I think we have seen investors just colloquially, particularly like venture investors and other smaller private equity investors, be very interested in brands that are achieving or unlocking net new distribution channels, particularly across marketplaces. So whether that's obviously D2C brands expanding into Amazon, but also brands experimenting with TikTok Shop, brands experimenting with GoPuff, Faire, other distribution marketplaces, I think is definitely a trend, and being able to show that you can successfully execute across those new marketplaces, I think is definitely an advantage, especially because there's usually an early arbitrage for brands that are early. In particular, we're seeing brands on the D2C side. A few of our brands are having great success with TikTok Shop, which is interesting, right? And I think that arb will probably go away over the next little while, but it's definitely there now.
Great, thanks, Austin. Question: what are the trends for a split of consideration across upfront and deferred? Before the market correction about 2 years ago, we were typically seeing 80, sometimes 90% upfront. The balance deferred now it can be anything from 60 to 80% typically is upfront. clearly it depends on what the seller wants. If seller is willing to accept who wants everything up front, or a good chunk up front, will accept a lower valuation multiple, that can be a different deal dynamic. But generally it's sort of 60 to 80% up front. There's an interesting question there. Is there a multiple boost if sales are reoccurring versus recurring, i.e. subscription versus repeat? And I think the answer is absolutely. Subscription businesses trade at higher multiple than those that have repeat purchases, because generally they're locked in, they're more solid, typically annual or ideally annual subscription, as opposed to just returning customers. Any further?
The only thing I'd say there, Emmett, is there's a couple of interesting public comps, in particular Oddity and Figs, that I would point out that don't necessarily index heavily toward a contracted subscription model, but have incredibly good repeat dynamics that are actually trading at a higher multiple to some of the more subscription brands. So I do like the metric that people are going to, or at least what I've seen, is that the most sophisticated acquirers and investors are going to look at your underlying cohort data, regardless of your subscription, your contracted subscription model. So the subscription model often leads to much stronger cohorted retention, and it obviously has an impact on customer lifetime value. But you can achieve a similar, I think, premium for you have to have a significantly long cohort history, so 2 to 3 years, I would say, minimum. But being able to show that, even if it's not contracted, I think can still work in your favor.
Yeah, that's fair. Austin, question from Lonnie: as the e-commerce sector grows, sustainability becomes increasingly important. Is there a need for sustainability practices for brands as they think about growth and exit strategy? I mean, I think broadly, yes. I mean, ESG, environment, social governance, is a big theme amongst investors and acquirers. So having a sustainable angle is key, particularly over a multi-year period. It's only going to increase. Austin, John, Simon, any thoughts on that one?
Yeah, just you just narrow your investor base. You narrow the market that you can go to very quickly without having the ESG component to your business.
Some insights on the sports category would be great. We own one of the major soccer brands on Amazon. Raj, maybe please contact me direct and I can connect you with John at Grips as part of that.
I'll up with you there.
What do you think the outcome of the Thrasio restructuring will be, and the follow-on effects opportunities for the wider e-commerce aggregation brand space? My personal view is that the recent news is a positive. There were rumors last September that it was filing. It hadn't filed at the time. Yes, it's filed, but it raised 90 million and is looking to keep going. So overall, I think it's a positive. There are clearly aggregators that are finding life tough at the moment, but it's not all bad news. There are aggregators that are doing relatively well, particularly I think those that have niche strategies, either focusing on the category, etc. And of course, there are DTC aggregators seem to be doing maybe marginally better than FBA aggregators. There's obviously different types. Any thoughts on that one, gentlemen? No. Okay. We've run out of time, folks. There's lots more questions there. I'll try to respond as part of a follow-up. So I'd just like to thank the panelists, John, Austin, and Simon, for taking time out today, and for all of you for attending. As mentioned, the deck will be circulated as part of the follow-up. All recordings of these webinars are posted on our YouTube channel. Just click the Fortia Group or insert the Fortia Group into YouTube, and you'll see all prior recordings. And please reach out with any questions at inquiries@thefortiagroup.com. Thank you all and have a lovely day. Bye-bye.